Welcome to our Hurst Cycles webinar for the 11th of December 2017. My name is David Hickson, and as always, before we take a look at the markets, I must ask you to make sure that you have read and understood these disclaimers. Now, in this webinar, I'm going to be doing a fairly unusual thing, unusual for me, because I'm going to be taking a look at a very long-term picture of what might be happening in the markets. It's unusual for me because my trading is very much based in a fairly short term. When I started trading, I was interested in taking trades for a few weeks, perhaps at the most. So I was focusing on the 40-day cycle. Then I started focusing on shorter time frames. I now mostly focus almost entirely on intraday trading, although I still do some what I term longer term trading, which is a matter of weeks, perhaps even months sometimes. But the concept of looking at 150 years worth of data, which is what we see in this chart, is a fairly new thing to me, which is why I describe it as being fairly unusual. So this is data for the S&P 500 going back to 1870. And I downloaded it off the internet. It comes if you search for it, you can find it. To be honest, I cannot remember the source of the data. But here, the first thing that must be pointed out, of course, is that we're looking at a logarithmic scale of this data, because if we change that to a linear scale, then it looks as if there absolutely nothing was happening before 50 years ago. There's a linear scale. And it looks as if the markets have been tremendously exciting over the past sort of 30 years, perhaps. And for the 120 years before that, absolutely nothing happened. And that's because in a linear scale, the y-axis equal increments of the y-axis are equal movements in price. And when you're looking at a very long-term chart, you need to be looking at logarithmic scaling, of course, where equal increments on the y-axis represent equal percentage moves, which is a much more realistic way of looking at long-term data. And so here on this chart you can see some of the obvious highlights: the 1929 peak, the Great Depression, the big drop down into 1932 over there. Here's a 1974 low, which is generally considered to be a very important low. Here's the 2000 peak, 2007 peak over there, and here's the 2009 low. And of course, here we are, right up at the top of the chart in 2017. So let's start speaking about cycles for a very long-term analysis. First of all, let's just take a look at a default analysis that has been applied to this chart using Hurst's default nominal model. You'll know that Hurst himself defined the 18-year cycle as the longest cycle in his nominal model, although of course he said there are cycles that are longer than 18 years, but he didn't define any. And so the first question that we need to ask when we perform an analysis is, what are those longer cycles? Because here is an analysis on this chart which goes up to the 18-year cycle, which is kind of interesting, and we could spend the webinar talking about this analysis. But what we really want to be doing when we're looking at such a long-term analysis is start speaking about some of these longer-term cycles. So what are those cycles? Well, there are various approaches to determining what the longer cycles are. The most obvious approach is to simply extend the simple harmonic ratio upwards. So from an 18-year cycle, we could take the option of simply going from 18 years up to 36 years, then 72, then 144. Okay, that's the simplest approach, and we're going to take a look at an analysis in a moment that does take exactly that approach. But then, of course, there is the interesting slight anomaly in Hurst's nominal model between the 18-month and the 54-month cycle, and so possibly the same thing happens on a yearly basis. Does it? Well, I don't know, but it's a possibility worth considering. So we're going to take a look at an analysis that has an 18-year cycle, and then a 54-year cycle, and then a 108-year cycle, and so forth. And then we're going to take a look at another nominal model that I would like to suggest. So in terms of working out what the longer cycles should be, I thought it'd be interesting to do a bit of an internet search and see what other people had to say about cycles that are active in the stock market. I did a very simple search and came across this Wikipedia article about stock market cycles, and you can see there's actually very little mention about any of the longer cycles. The longer cycle that they do mention here is a very well-known cycle, the Kondratiev cycle. That's spelt with a V there. Sometimes it's spelt with a double F. Kondratiev was an economist, I believe, who wrote about a cycle that is somewhere between 50 years and 60 years in length. So a lot has been written about it. There's a lot of evidence that a Kondratiev cycle, or a cycle between 50 years and 60 years in length, does exist. And so, that's something that we definitely need to be looking for. Where is the Kondratiev cycle, or where is that 50 to 60 year cycle in the market that we're analyzing? So that's something that we're going to bear in mind as we take a look at this. Interestingly, in this article in Wikipedia, there's another mention here of the 17.6 year stock market cycle, and that's based on a book that was written in 2013. Now, Hurst, of course, defined the 18-year cycle, and the exact length of his 18-year cycle is a bit shorter. It's in fact 17. I think it's 17.9 years. I'm starting to be correct. It's either 17.9 or 17.4, but it's sort of within that range. So I noticed this mention of the 17.6 year stock market cycle. I thought I would take a look at it. It's based, as I mentioned, on a book, and here is that book, the 17.6 year stock market cycle, written by Kerry Balenthiran. I'm not sure if I'm pronouncing that correctly. A book written in 2013. And thanks to the publisher, we're able to take a quick look at the the chapters and the outline of the book. So I took a quick look at this to see what 17.6 year cycle this person has identified. They've named the cycle after themselves. It's now called the Balenthiran 17.6 year stock market cycle. But interestingly, they are measuring the cycle from the beginning of a bull to the end of a bull, or from the beginning of a bear to the end of a bear. So in other words, they're measuring the path up as 17.6 years and the path down as 17.6 years. So in terms of a Hurst cycles approach, that's not in fact a 17.6 year cycle, that's a 35.2 year cycle. Okay, because of course we measure from trough to trough and peak to peak. So I thought that was an interesting little diversion. Let's take a look at some analyses. And so here's the default analysis. With the 18-year cycle at the bottom of the chart. Let's move straight on and start taking a look at some analyses of the longer cycles and see what we can gather from that, and see what what we can decide is probably happening in the markets. So let me just turn off the peak analysis here, and here you can see we have the longest cycle in this particular nominal, or this particular analysis, has been found to be 65.9 years. So the nominal model on this chart, you can see that the chart is actually named 2 to 1, and that's because I've gone from 18 years. Okay. Oh, I'm really struggling to write here. And I've simply doubled that to 36 years, and then 72 years, and then 144, although of course we don't find 144 year cycles in there. So that's this nominal model. The harmonic ratio between each one of the cycles is 2 to 1. Each one of the cycles is twice as long as the previous cycle, the shorter cycle. And there are a few interesting things to point out. First of all, 1877, there was a trough of the 65.9 year cycle, which is this nominal 72 year cycle. Okay, I find it interesting that the analysis has shortened that from 72 years. It's been looking for a 72 year cycle, but it's found a 66 year cycle, and that 66 year cycle is getting fairly close to that Kondratiev range of 50 to 60. Not perfect, of course, but it's an interesting observation. So we have a trough in 1877, and if you read about really long-term economic history, you will see that the 1877 low, or the 1870s low, is generally considered to be a really important low point in the markets, which is why I've got no problem with placing a 65-year cycle trough down there. The next one, of course, comes in at the 1932 low, and so that's the bottom of the big plunge from 1929. And our next 65 or 66 year cycle, interestingly, comes in here at 2009. Isn't that interesting? So is it possible that 2009 was in fact a 66-year cycle trough? Well, it is possible, but it's time for me to make a very big disclaimer in terms of what I'm talking about in today's webinar, and that is that I hope that this webinar is going to prove to be a catalyst for you to do your own research and to get some conversation going. I'm very cautious always about saying, oh, the trough in 2009 was a trough of the 66-year cycle, because we don't really have enough information to make such a bold statement. So it's interesting to consider it. Certainly that 2009 trough looks to be a very important trough in the markets. Perhaps it was of 66-year magnitude. But I'm mentioning these things and I'm showing these analyses in the hope that it will trigger some dialogue and some interesting conversation. I'm not making an absolute outright statement that 2009 year 2009 trough was in fact the 66-year cycle trough. That's a fairly bold statement, and I'm not really ready to make quite such a bold statement. But the other interesting thing about this analysis that works quite well is that the 1974 low, which is generally considered to be a very important low, I know Elliott wave practitioners generally count that 1974 low as a very important low according to Elliott wave theory, and you can see that low is a low of the 36-year cycle, the nominal 36-year cycle, which has been found to be of about 33 years in length in this particular analysis. So there are a few interesting things there. I mentioned a moment ago the 17.6-year cycle, that book written in 2013, and how that person has been counting from from a trough to a peak, and then from a peak down to a trough, giving us in total about a 35-year cycle. So here we have a 33, or it's a nominal 36-year cycle that has played out from 1930 to 1970. Some of the pieces of this puzzle are beginning to fall into shape. Now, this is one of the possibilities. And before we take a look at another possibility, I'd like to point out something interesting that's happening here. And let me just clear that. Here you can see I'm going to draw over the price because I only have monthly price, so it's sort of dotted. It's not very easy to read. So I'm just going to draw over the price. I'm sure you're sort of familiar with that chart if you've spent any time studying historical charts like this. But that big move down is, of course, the drop from 1929 down to 1932. And then the markets formed a little bit of a triangle. Okay, over there. Now, when it comes to performing a Hurst cycles analysis, and we're faced with a triangle, one of the decisions that one has to make when doing your analysis is, do you place the really big trough at the end of that first big move down, in this case 1932, or do you place the trough at the end of the formation of the triangle, which in this case would be, I think that was in 1942, if memory serves me correctly. So, where do you place the trough? Now, this analysis has placed the trough in 1932, which seems an obvious place, but another very reasonable place to have positioned it would have been in 1942. And if we just quickly switch back for a moment to our default analysis that only goes up to the 18-year cycle, you will see that, in fact, the analysis that Sentient Trader has performed, and I'm working entirely with completely default analyses here. I'm not, I'm not affecting them in any way. I haven't done any pinning or anything like that. But here, and now that I've zoomed in, you really can't see the price at all. In fact, I don't even need to do that. I can, if I remember how to work with the software, I can simply draw a line. There we go. Okay, so You can see in this analysis, interestingly, the 18-year cycle trough has been placed in 1942, and the previous 18-year cycle trough was placed in 1921, and the low in 1932 has been marked as a trough of the 9-year cycle. So that's a very valid way of interpreting that period of time, and so it's just something to bear in mind as we move forward. So we've taken a look at one of the possible analyses. Here is another one which assumes that we have a 3-to-1 ratio somewhere in the nominal model at the 18-month level. So in other words, we go from 18 years, I beg your pardon, I said 18 months, I meant 18 years. So we go from 18 years up to 54 years. Okay, just as we do on the monthly time scale, we jump from 18 to 54. That's a 3-to-1 harmonic ratio. And then our next longest cycle is 108 years, although we don't have enough data really to sensibly position a 108-year trough. And this is the analysis that has been performed on the basis of that nominal model. So let's take a look at it. Here is one of the 54-year cycle troughs, which is in 1877, and here is the next 54-year cycle trough in 1942, just as in the example I showed you a moment ago, where we have the 1921 trough as being a big trough, and then the next bigger trough is in 1942, and then we get this next 54-year cycle trough over here, and that is, I think I'm correct in saying, in 1987. So this analysis, I've got to say, doesn't work nearly as well for me. And what doesn't really work for me is the position of that 54-year cycle. The position of the 18-year cycle troughs, and you can go through each one of them and have a look at them. You know, I'll just circle them here, but you can see all those 18-year. Gosh, I'm so used to saying 18-month. All those 18-year cycle troughs all look very good in the analysis, in my opinion. The misplacement is the 54-year cycle trough, which just doesn't work so well for me. You know, here we have 1877, fine, that's good. 1942, okay, as I've just mentioned, because that's a triangle that formed over there, that's a reasonable position for that trough. But this one over here in 1987, it just doesn't really ring true, that 54-year cycle trough over there. So in terms of my exploration of the longer term analysis of what's happening, I would be inclined to reject this particular analysis, which then would take us back to our previous 2-to-1 nominal model, harmonic ratios of 2-to-1 all the way, 18 years, 36, 72, and so forth. It's worth pointing out here that in this analysis, the 2009 trough, which is still a trough that is influencing our trading today, was a trough of the 18-year cycle, not a trough of the longer 54-year or 66-year cycle. So, how big was that trough in 2009? Well, my level of confidence in that trough is, certainly at the 18-year level at the moment. It might have been a longer trough, but I would be a little hesitant about declaring that and shouting it from the rooftops. Now, we've taken a look at these two analyses, and the better one, as I've mentioned in my opinion, is the 2-to-1 nominal model. Let's take a look at a third possible nominal model and speak about that nominal model. Now, this model requires a little bit of an introduction. It works with a 42-month cycle, and the 42-month cycle is something that has been discussed many times on the forum, I know, and it is something that the late John Eastreich discussed in his webinars about gold. He worked with the 42-month cycle in his analysis of gold, and there are several really very experienced Hurst cycles analysts working today who work with the 42-month cycle. The fact that there are several of them, I should point out, doesn't necessarily mean that they've all come to the 42-month cycle from a different point of view. Of course, we all talk to each other, and it's quite possible that the concept of a 42-month cycle all comes from one source. I think William has had a lot to do with that. You'll know from his writing on the forum and on the Hurst Cycles blog. Of course, he's mentioned the 42-month cycle. So. It's a very interesting cycle, and I've been exploring it quite extensively recently. And I thought I would build a nominal model that takes as its basis the 42-month cycle, instead of just simply starting with an 18-year cycle. So I've started with a 42-month cycle, and where does that take us? Well, we have 42 months. And sorry, I don't have my pen, so that's all coming out a bit wobbly, but hopefully you can read that. 42 months. And double 42 months is, of course, 7 years. And we could split hairs and say it should be 7.2 years or 6.9 years, but I'm just calling it a 7-year cycle. Then we have the 14-year cycle. Okay. Then we have the 28-year cycle. That's a really wobbly 28-year cycle. And then we have the 56-year cycle. Now, one of the reasons that I find this so compelling as a nominal model to work with for this very longer term analysis is that this 56-year cycle over here fits very nicely with the Kondratieff cycle. And I'm not going to try and write Kondratieff. So that 56-year cycle, it's a very likely and very possible candidate for the Kondratieff cycle. It's an interesting nominal model. Let's see what the analysis shows us. Again, we have the longer cycle in 1877. We have the next one in 1932, although that one could potentially be displaced without really substantially affecting this analysis very much to 1942. And then we have our next really long cycle trough over here in 2009. So I find that really quite interesting. And our next shorter cycle fits in very nicely over here in 1974. So there is our 30, what should that be? That should be the nominal model, the 28-year cycle. But you can see in terms of the wavelengths that have been found in this analysis, that the wavelengths that have been found very closely match the analysis we were looking at earlier, with 65.9 years, 32.9 years, and 19.2 years, even though I have applied a fairly different nominal model. And that brings up a very interesting point, which is that, of course, Sentient Trader has some flexibility in applying the nominal model. It's not completely fixed. It allows a good deal of variation in these cycle wavelengths. It allows up to 50% wavelength, 50% deviation in wavelength. Although that gets a little more complicated as it works down through the lower and lower cycles, it'll allow a much wider difference of wavelength. So I think this is really a fairly compelling analysis, because we've seen it now pretty much twice using two different nominal models. So let's explore this analysis just a little bit further, and let's first of all put up our semicircles and speak about what this analysis is really telling us. Well, between 1877 and 1932, or maybe 1942 if you want to stretch it that way, we had a long cycle, 65-year, maybe that's the Kondratieff cycle, I don't know, moving the market upwards and then downwards fairly dramatically. Then we had another one of those really long waves moving the market up to a probable peak round about here in 2000, and then it came down to 2009. Okay, and so now we are probably, according to this analysis, in our next one of those really long cycles. So it's a very interesting analysis. I'd love to hear what you all think about this analysis. Let's take a look at some more of the details. First of all, let's quickly zoom in here. Let me turn off the semicircles before this all gets very messy, and then we'll zoom in and take a look, because even though we're looking at a really long-term analysis, I do like to sort of bring it back to a little bit of reality in terms of what we're really looking at now. So here is our really long cycle trough in 2009, and according to this analysis, the trough in 2016 over there was a trough of the 9-year cycle, or this nominal model, it's a 7-year cycle. It's found the average length of that cycle to be 8.4 years. So, that analysis is the analysis that we've been looking at. It's the analysis we've been discussing in our recent webinars and so forth. And we have an 18-month cycle trough that has formed over there. In our previous webinar, I spoke about peaks. So let's just quickly wrap up this discussion of a really long-term analysis by taking a look at a peak analysis. And I'm not going to be tedious and go through every single possible nominal model. Let's simply start with this nominal model that we're looking at here, and let's take a look at the peak analysis. The first thing to be said about the peak analysis, of course, is that in Hurst's original work, he stated that stock markets have synchronized troughs, and therefore you can perform a synchronized trough analysis. Okay, and here I'm throwing up a peak analysis which makes the assumption that we have synchronized peaks, which is in direct contravention of one of Hurst's principles. So why do I do this? I do this because by applying a peak analysis, you can often get some very interesting insight. At least I've found that to be the case on a very short-term basis, particularly intraday. It gives very, very useful insight, and with the shorter cycles. Does it work with the longer cycles? I don't know, to be honest, but here is an analysis for us to have a look at. And you can see here that we have a very big peak in 1929, which is fairly obvious. We have a next very big peak over here in 1987, I think that is, which doesn't look very good to me. Okay, so how do we deal with that? Well, I deal with it in the way that I deal with all the anomalies that I find on an analysis, and that's that I look at what's my level of confidence. So what's my level of confidence in this peak analysis? I'm not confident in this 54-year cycle peak over there, so I'm going to ignore that. Am I confident in the next shorter cycle, which is a 28-year cycle? Well, that gives us a peak somewhere here. I can't really see a peak there that's fairly obvious. It gives us a peak here in 2000. In the year 2000, it's okay. So yeah, maybe my confidence goes up to 28 years. I'm not sure that I would be quite that bold. So my confidence definitely goes up to the 18-year level. Okay, so at the 18-year level, that's nevertheless a fairly long cycle. So it's certainly something that we can look at here. And so at the 18-year level, there's that 18-year peak over there, and you can see from the nest of highs over here that the market is heading up into the next 28-year peak, although my confidence is not at the 28-year level, so we're heading up into the next 18-year peak. Well, that's really quite interesting. Let's measure how long it has been since that previous 18-year peak, and here you can see that it has been 17.66 years since the 18-year peak in the year 2000. Now, have we mentioned a 17.6-year cycle before in today's webinar? We have indeed. Okay, that 17.6-year cycle is the cycle that is written about in that book, although of course that author was writing about peaks down to troughs, but one of Hurst's original cycles was the 17.9 year cycle, I think it is, indicating that we are really approaching a point for that peak to occur. Now, the exact length of Hurst's 18-year cycle, I think I'm correct in saying, is 6,552 bars. So that would seem to indicate that we're looking at the next 18-year peak occurring within the next 100 bars. So, yeah, yet again, we are certainly looking out for a peak. And let's just go back to our 2-to-1 analysis. I think on the 2-to-1 analysis, we have an interesting situation with the peaks, or perhaps it was on the 3-to-1 analysis. It should just be worth taking a look at that. Yes, it's not on the 2-to-1. It's on the 3-to-1 analysis. We have a better peak analysis, in my opinion. But it's time for me to wrap up. We'll take a very quick look at the peaks here and see if we can get any further clarity in terms of the peak that we are heading up towards. Here we go. Okay, so here is our peak analysis on this chart. And remember, this is the 3-to-1 nominal model, so we have a 54-year cycle, and there is a big peak over there. Here's one over here, which is a little bit debatable. I'm really not sure about that. But here, the 2000 peak is also an 18-year cycle peak. And so we are seeing a very similar situation playing out in this particular analysis. Let me just zoom in. We have a neater nest of highs, I believe, in this analysis for us to consider. And so there we go. And so here is the 18-year peak in 2000. And as I've pointed out, we're now heading into the next 18-year peak. Here is the nest of highs. Not a very neat nest of highs, but remember, we don't expect the peaks to be synchronized. So, we're not expecting necessarily the 18-year peak to be perfectly synchronized and absolutely perfectly on point, whereas we do expect these troughs to be synchronized. And you can see the 2009 trough as an 18-year cycle is really looking very good over there. And as a matter of interest, in the book that I was speaking about earlier, where they're speaking about the 17.6-year cycle, they were projecting a 17.6-year cycle down from the year 2000. In fact, let me just remind myself of what that was. And here we go. And here it is over here. You can see they have mentioned a bear market from the year 2000 to the year 2018. Well, we certainly had a bear market from 2000 until 2009, but it didn't carry all the way through to 2018. And why is that? Well, of course, as a Hurst cycles analyst, you know the answer to that. And it's very clear on this chart. Price moved from the 18-year peak in the year 2000 down to the 18-year peak, I beg your pardon, the 18-year trough in 2009. And it did it in a perfect zigzag. Oops. Moving first down to the 9-year trough, then up to the 9-year peak, and then finally down into the 18-year trough in 2009. So what we're seeing now is the bounce out of the 18-year trough up to an 18-year peak. And that 18-year peak is expected fairly soon. We're looking at a long-term chart here. To say it's expected within the next several months is certainly fairly reasonable, in my opinion. And so yet again, we sort of reach the conclusion that we are looking for a peak to form in the markets fairly soon, and it could be a fairly substantial peak. Let me answer a few questions that have come up. William asked about the book that I mentioned. That book was, let me just see if I can switch to it. Here we go. That book was a book that I discovered. It's not a book that I'm familiar with, William, at all. It's a book that was published in the year 2013. Here is the page on Amazon.com, the 17.6-year stock market cycle. I was just really interested to discover it because as Hurst analysts, we're always talking about an 18-year cycle or a 17.9-year cycle as being the longest cycle in the nominal model that we analyze with. And I was really surprised to find that a book had been written about a cycle. And as David at Trading Hurst mentions, he doesn't refer to Hurst at all. So he's discovered a cycle that definitely has its roots in Hurst's cyclic theory, and has written a book about it. So you might find that interesting to look at. I thought that it certainly made for a very interesting consideration in terms of when you're looking for what that longer cycle is in the markets. Because, of course, um, one of the questions that is often asked of me is what happens after the 18-year cycle? And it's something that, to my knowledge, Hurst himself didn't really speak very much about. I'm not necessarily recommending the book. But I do think it's very useful and very interesting to look at what other people have written about the cycles and the longer cycles. It's been very interesting for me to take a look at such a long-term view, something that as I mentioned, I hardly ever do, and it's been really, really interesting to consider what those really long cycles are doing. Because, of course, I'm of the opinion that when you're trading over a period of several weeks, several months even, then what the really long cycles are doing is not really very, very important. But knowing or believing that the markets are heading up now into an 18-year cycle peak, which seems really possible, or if not likely to me, certainly adds weight to the fact that we're looking for a peak to form in the market. But of course, I do think it's important not to say, oh, well, because we're heading into a peak of 18-year magnitude, that we're definitely going to be bearish for a very long time afterwards. As we watch a peak forming in the markets, we need to be standing by to calculate and observe the magnitude of the peak as it forms, because we need to be trading with all the information that we have available to us. And of course, if that's going to turn out to be a much lower magnitude peak, then we need to adjust our trading decisions on the basis of that. Peter says, has anyone tried long analysis of a particular sector like financials, gold, industrials, or energy stock? Maybe the sector's not perfectly synchronized. Peter, I haven't done that. I'm not sure whether anybody else has. It'd be very interesting to find out whether anybody has. It's certainly something worth doing. For many of the sectors, I think you might find that there is not quite as much data available, because, of course, many of the very old data, much of the sort of very, very old data is is artificially generated, so I'm not sure you would find that data for the separate sectors. Dale says, can you examine the FLD interactions on the long-term basis? Interesting question, Dale. And I see William says, can you show the chart I sent you? Yes, William, let me see if I can find that chart on this computer, because when we last spoke I was on a different computer, but I'm going to see if I can pull it up quickly and show you. But let me quickly answer Dale's question. Can you examine the FLD interactions on a long-term basis? If you're asking me theoretically, can you do it? Then I think the answer is certainly yes. So what we could do is have a look at some of the really long FLDs here. There is the 9-year FLD, and there's the 54-month FLD. There's the 18-month FLD. So there we've got a couple of long-term FLDs that are definitely worth looking at. If FLDs, in my opinion, work across all time frames. You probably want to be looking at a monthly chart when you're looking at a 9-year FLD. Otherwise, you're going to get horribly sort of chopped up in all the smaller day-to-day details. So you would want to be looking at a different time frame for these longer FLDs. But the generic answer to your question, Dale, is, in my opinion, certainly yes. Let's have a look at some FLDs on this analysis, which, in my opinion, is the best analysis to be really watching. And so there's the 42-month FLD. And let's see if we can start building a bit of an idea of the FLD trading strategy here. Let's turn off that 30-week. So here we have price crossing up above the 42-month FLD, this position over here. So here we have price crossing up above the 42-month FLD following a major trough. Then it came back to the 42-month FLD, found support at it, and then came back to it again and found support at that FLD, and it's now bouncing up again. So of course the next interaction that we're going to be looking at is going to be for price crossing down below that FLD. So and if that's the 42-month FLD, then that would be the A category interaction, and this would be the BC here, and this is the D and E over here. So our next interaction would be expected to be the F category short interaction. So there we go. There's rather a sort of long, detailed answer to that. I think the answer is yes. I would certainly say that FLDs work at all time frames. David at Trading Hurst says support from the 54-month nominal FLD was telling for the low in 2016, and I think in fact that's exactly what we've just looked at. Is the as he says, it's the 42-month nominal FLD. So let's just zoom in on that because it's a really important point, and so my computer doesn't want to allow me to do that. Okay, so here if we zoom in on this chart, and we zoom in even a little more, the 2016 low, here's the 2016 low, which was happening, and here we're looking at a daily, a weekly, and we probably want to be looking at it on a monthly basis, or no, maybe a 42-month FLD we'll look at on the weekly chart. And so there you can see exactly as David is saying, the support that FLD provided at the 2016 low, was very telling, very important. There's the FLD providing support to price, and the bullishness of the market is revealed by the fact that was probably a 9-year cycle low and not, in fact, a 42-month cycle low. It was probably a 9-year cycle low, and the tremendous bullishness of the market was revealed by the fact that the 42-month FLD held price at that point. I hope that makes sense. A very interesting observation there. And David says he thinks a decent break of that FLD will confirm the 18-year peak. So let's see what we'll be looking at for the confirmation of the 18-year peak. My computer doesn't want to show me my taskbar. There we go. Okay, so in other words, this is an FLD well worth watching for confirmation that the 18-year cycle peak has formed in the market when price comes down and drops below this 42-month FLD. And I should never draw arrows like that, should I? That implies I'm expecting the peak now. So when price comes down and crosses below this FLD, which it certainly will at some point, that would be confirmation that the 18-year cycle peak has formed in the markets. And let's just pop up one shorter FLD, the 14-month, for instance. There's the 14-month, and there's the 30-week. So we've got a really great pattern here with our FLDs. What Hurst referred to as a cascade pattern, although I think he referred to the upside down cascade as a waterfall pattern, did he? I'm not actually sure, but we've definitely got a good pattern with our FLDs, indicating that when price starts taking out those FLDs, we need to be on the standby for the fact that a peak has formed in the markets. Here we go. This is a chart that William was kind enough to share with me, titled "The Mother of All Waves," showing data in the S&P 500 going back to 1870. And you can see down at the bottom a sort of a detrended, in other words, a lot of the sort of the tremendous bullish strength has been extracted from that price, and you can see a very nice regular price action over here. I hope that you are in fact now seeing this. And a really fascinating chart. William, if you have any comments to add to that chart, then please go ahead and put them into the chat window. You can see here a very clear cyclicality, and interestingly, you can see here with this cycle line, this enhances the concept that the low price for the cycle analysis should probably be down here in the 1940s as opposed to 1932. Okay, I hope that you can see that. I'm going to have to switch back and look at the chat from the chat window so that I can see anything that you're saying. Goodness me, it's like working with one screen is certainly a bit of a challenge. So as William says, this is a chart that's been generated using Hurst's filter process, which is the process that he wrote about in the Profit Magic of Stock Transaction Timing book. And so this is an updated chart for that, bringing it all the way to 2017, because of course Hurst wrote that book at the end of the 1960s. I believe I'm correct in saying 1967, 50 years ago. We're going to have a celebration for the publication of that book. So that was here in 1967, and this chart has been generated, has been updated, and it's been generated using the same filter process. That circle is where Hurst published his book, and so it's an updated chart, and it shows the reliability of that same cycle, presented down here at the foot of the chart. That same cycle continuing through to the current day. A really fascinating chart. The kind of chart that gives Hurst analysts warm fuzzy feelings. So thank you very much for sharing that chart with us, William. And in fact, if I might add, one of the very interesting points that William mentioned is that the nominal model that, of course, Hurst published in the 1970s in his cycles course was probably largely influenced by the cycles that have been operating sort of more recently in the US stock market. And that now that we have an extra 50 years worth of data, it adds weight to the argument that the 54-month cycle that Hurst found in the 1970s is most probably more correctly assumed to be the 42-month cycle. So, in other words, Hurst just happened to find that cycle at a time when it was running a little bit long. It was running about 20-25% long, and in fact, a better assessment of that cycle today is to treat it as a shorter 42-month cycle. So, I think on that point, I see William is saying absolutely. Thank you for sharing that information with us, William. It's really a very important. It's very important, of course, to keep updating what Hurst did. When I started off working with Sentient Trader, I was determined to make sure that I really stuck to what Hurst had done, because I felt that was very important. And as the years have passed, it's been really useful to gain the knowledge of many analysts who are working today, and without moving away from Hurst's original concepts, to be able to refine them. And the information we're working with today is really wonderfully accurate, I believe. When you get a really good Hurst cycles analysis working on your charts, and you can see the accuracy of it, it's very rewarding to know that that's the result of many years of research from many different people. So, on that note, thank you very much for joining me in today's webinar. It's been fascinating to me. Thank you to the several people who said please do a longer term analysis. Because it's been absolutely fascinating for me to look at a longer term analysis. I found it really interesting. I hope that you have too. I wish you all a wonderful festive season going into the Christmas and New Year period, and I look forward to seeing you at our next webinar, which is going to be in January. So thank you very much for joining me. I look forward to seeing you next year. In the meantime, profitable trading. I wish you all a safe and very festive holiday season, and I look forward to seeing you all next year.